Some people like to say, if it's free, it's for me. Well, that may not apply to mutual funds. Fidelity has these fee-free funds that this author was talking about, and he was asking, well, what's the catch? Well, according to the prospectus, everything seemed to check out, and Fidelity is actually paying to manage people's money. Think about that for a second. Now, they do lend securities, and they can make back some of the money that way by keeping that lending revenue. One of the things he said that they're hoping is that you'll move money to other funds where they do charge fees and that you'll trade more often. So that's one of the catches right there. And according to Wikipedia, Fidelity's 2017 revenue is about $18.2 billion. So Fidelity does know how to make money. Some of the other issues. Funds are weighted by company size. Now, in a fund of well over 2,000 stocks, 33% of the money is in just 30 companies, so it's weighted based on capitalization, so that's one problem. Another one is that the number of holdings per country is limited. I looked at my portfolio and I have about 660 stocks in the UK. Their international fund only has 123. I have about 294 stocks in France. They only have 58. So we have some diversification issues within countries as well with these funds. Now, they're also ignoring much of the research on the factors that drive anywhere from 95 to 96 or even higher percent of investor returns, and that's a real big problem. They're ignoring size by weighting bigger companies more. They're also overweighting growth companies versus value, and that's a problem. And they're ignoring, of course, the profitability factor that I've talked about in some of my nerdier workshops. They're also ignoring investment factor, which I don't talk a whole lot about, but that is a problem. And then reconstitution. When you have an index fund, you have to reconstitute it so often to make sure that it matches or mirrors the index. And there is a cost to that that is ignored in the management fees. And then, of course, we have a diversification problem that I pointed out. When we look at 5-year premiums of large versus small companies, we see that small companies historically outperform large companies by a significant margin, and we don't want to ignore that in the investing process. Even more problematic is ignoring value versus growth. Value companies tend to outperform growth companies, even in as short a period as just 5 years. And then, of course, the profitability factor going back to the 1960s, ignoring that is a problem. So when we go fee-free, we may be giving up a whole lot more than we're thinking about when it comes to investing.